first part is pretty much what I gave last year, and so those of you who heard it last year will sound very familiar. And the design of that part of the talk is basically directed toward people who know nothing about how the banking system works, which probably describes none of you here. It's the only value of it is that you will just see how at least one person, namely me, has presented these ideas to others who are naive on the subject matter. Part two is going to be a little bit different, and that's going to be as a result of conversations I have had with two local bankers. Okay, so that's interesting. Okay, so let's begin here. I'm going to hold this, I think, so I don't have to stick right to there. All right, but I have to stick to here in order to advance the slides. So all of you have encountered this quote by Henry Ford, but it makes an enormous impact on people who don't know anything about the monetary system. For what he said was that if people really understood the banking system, there'd be a revolution by tomorrow morning, and tomorrow morning has come and gone and come and gone and come and gone, and has been no revolution, and that's because people still don't understand the system. So let's go to basics. What is the economy? And the economy is basically an exchange of goods and services amongst people. The exchange of goods and services is of course, mediated by money. So we can view the economy as a circulation of money. So where does this money come from? How is the money created? That is the question that we're going to address here. Well, there are two sources that can be used for money creation. Money can be created by government, and money can be created by banks. When that happens, they really create credit that we use as money. Now, let's talk briefly about what would happen if governments created money. If governments created money, then the government, money created by the government would be spent into circulation for things that government does. It builds roads, it has educational institutions, it has justice systems, it has lots of good things that we all depend on. Okay, so if governments created money, that's where the money would presumably go if they make wise decisions. So that would allow the economy to grow. Now, when government creates money, the creation of money can be tied to the growth of the real economy, okay, and thus eliminate these boom and bust cycles that have characterized our economy over the decades. And when government creates money, in principle, there is no debt created from money creation. Money created by the government, in matter of fact, could be used to pay down the national debt as it becomes due. Now, at this point in the talk to young people, I use a little a 3-minute video that's on the Positive Money website, and the reference to it is down there below. Why is there so much debt? And that pictorial video does a really nice job in 3 minutes of making the following points here in a very graphical way that people understand. And so what it says, in today's world, money is created as debt by banks. Not because they're being criminal, it's just the way the system works. But maybe some people regard that as criminal. But in any case, that's how money is created, when banks make loans. And because money is only created as debt, society only has money when it has debt. And even though we all think it's be good to be out of debt, if we were all out of debt, we would be all out of money. So, in the current system, banks, not governments, create money. And this is interesting because you see these arrows. The upper arrow is the creation of monies, of credit, as banks make loans into the economy. Okay? Now, of course, we have to repay the principal back to the banks, and we have to pay the loan interest. So we have this remarkable situation, is that the very agency which is supposed to provide money actually takes more money out of the system than it puts in. How can that even be? Well, whoops. Why is that? Wait a minute, I have skipped something here. But let me try to answer this question here, but I would like to find the graph that I have. The only way this system can, let me get this. The only way this system can work is when the lending stays ahead of the repayments in time. And as long as the lending stays ahead of the repayments, then the money supply can grow. But if that doesn't occur, then the money supply shrinks. Now, people raise the question, that when we say that the banks, not the government, create money, they raise the question, well, wait a minute. We know how money is created. The bills are created by the Government Office of Engraving and Printing, and the coins are produced by the Mint, and those are government agencies. So, of course, how can you say this, that the government doesn't produce, doesn't create our money? And of course the answer, and this is repetitive because Nick has already referred to this, and these numbers are a little older than the numbers that Nick used, so they're a little more out of date. But the point is, the government can make 4 quarters, and they cost, the data that I had was maybe earlier, it cost 11 cents each to make a quarter, take them to the bank and get $1, and that's 56 cents profit for the government per dollar, and that profit to the government is called seigniorage. Okay. Now, what about paper money? Yes, the Government Engraving and Printing Office does print our bills, but no, the government doesn't create our paper money. And that's because the Federal Reserve banks can purchase the bills for the cost of their production, namely about 11 cents each for a $1 bill. And I think the figures that Nick had were a little bit different than that, but of that order. So the point is, the government, it changes every year. Good point. Yeah. So the point is that it's the banking system that gets the profit from paper money creation, not the government. Okay. But anyway, and the other thing that's asked, typically, we've said that in the previous slide, we said that the Federal Reserve banks can purchase these bills for the cost of their production. But people say, well, wait a minute, the Federal Reserve banks aren't they government? And of course, as I'm sure all of you know, that no, they're not. The Federal Reserve Board of Governors is not a bank. It's a government policy-making and regulatory agency. The board is just not a bank. Our central bank consists of the 12 regional Federal Reserve banks, and each one of these are owned by the private commercial banks in the region of the country that they serve. And Federal Reserve Bank employees are not government employees. And anyway, this conversation about coins and bills is utterly trivial because that only constitutes about 3% of our money anyway. The vast majority of our money is not in the form of coins or bills. It's in the form only of account money, essentially numbers in computers these days. And all this account money is created by banks when they make loans or buy securities. So the general conclusion here is that except for coins, money is created by banks, not by the government. And anyway, folks, if the government could create money, why on earth would it go borrow it? Why would it be in debt at all? The government does not create money. Money is created by the private banks. Okay, now, as we said before, the banks create the money by making loans. It goes into the circulating economy. And what comes out now is both the principal and the loan interest. So this is this problem of, yeah, they take more out than they put in. They provide the money supply, so how is this possible? And of course the answer to this is that it's only possible when lending stays ahead of repayment. Okay? So as long as that lending, the big fat arrow, indicates greater rate of money creation than repayment to the banks, then the system can grow. Money is going into the system. But if lending rates slow down, now you see that arrow is a little smaller up there on the top. If the lending rates slow down so that they are slower than the rate of repayment and loan interest, then the amount of money in the economy shrinks. And this is when recessions and depressions occur, jobs are lost, and people suffer. Oh, yes, isn't that cute? All right, so just on the simple basis of this utterly simple analysis of that we've seen money created by the government compared to money created by banks, or money created as debt, as credit by banks, which is better, to have money created as a public asset, which the government would do, or money created as a public liability, which the banks do? Okay? And most people listening to that say, that's an interesting point. Now let's look at this in a little bit more detail of how banks actually create money. And you have to look at bank balance sheets in order to appreciate this. And what's shown here are assets on the left column, and liabilities on the right. So the assets are, of course, what the bank owns and what is owed to the bank. Okay? And that's really two categories of things. One is sort of liquid assets, which is cash that they may have, central reserves, bonds that they can easily sell. And then they have illiquid assets, and these are the loans to customers, and they're illiquid, of course, because there's a scheduled repayment plan, so they can't get them back instantly. On the liability side, this is what the bank owes, and that's basically two things. It's customer deposits, what people have deposited in the bank, and stockholder equity, which has also been, in a sense, deposited in the bank. Okay? So now let's take a look at a bank loan and see what happens. Let's say Jack takes out a $10,000 loan, and here's what is entered on the bank balance sheet. The bank enters an asset of $10,000 because Jack is going to have to pay him $10,000, so that's an asset. Okay? They also set up a liability because this is the money that Jack can take out, that he can use, so they can set up an account for Jack. Okay? Now, this is, in a sense, $10,000 of new money created by the bank. It hasn't been transferred from somewhere else, somewhere, or someone else. All right? As a matter of fact, if Jack then changed his mind and simply wrote a $10,000 check back to the bank, then the liability, of course, would disappear to Jack because he would send the money back to the bank, and the asset would disappear too. So the money disappears when the loan is repaid. But of course, Jack doesn't want to do that. What Jack wants to do is buy a car. $10,000, I guess, would be a used car at best. And so this is what happens. Jack now writes a check to Sam for $10,000 to buy this used car. And for now, assume that Sam happens to have an account at the same bank. So what Sam does is take this check that he's got in his hand that's written by is written by Jack, and Sam takes it to his bank and deposits it in his account. Okay. So now, what the bank does with his check, it sees, oh, well, Jack has flattened his account because he's written this check to $10,000, and so he doesn't have any money left in his account. So Jack's account goes to zero. But now this check becomes a deposit in somebody else's account, okay, and namely in Sam's account. Well, what if Sam banks at a different bank? Well, what happens in that case is you find out that the whole system functions like one big bank, because each of the individual banks has an account at a central bank, okay? So what happens when the check that Jack wrote, that Sam takes to his bank, which is now a different bank, okay, that bank essentially has to let the system know that money has been transferred from Jack's bank to Sam's bank. And so that's what the clearinghouse function of the Federal Reserve is, of any central bank is, to essentially transfer reserves from the one bank to the other. So Jack's bank is going to lose $10,000 in reserves as it's shifted over into Sam's bank. So the whole banking system acts like a single bank. So the big picture then, of course, is that spending here on the right, the lending results in the spending. Let's say Sam now is spending into the economy for various things, all right? And then, of course, Jack over on the left is paying back the loan from the economy. So there's a circulation of this money from the banks, from the financial sector, into the economy, and then back out again. And if you look at this and you say, well, as long as loans stay ahead of the repayment and keep the system in money, looks like it's sustainable. Looks like it might work just fine. However, there are problems. And there are two kinds of problems. One is that the rate of bank lending varies, and it varies as a result of a variety of circumstances. So if that lending rate slows down, so it's slower than the repayment rate, now again we have money leaving the economy. There's less money to be used in the economy. The economy is essentially squeezed, and this is what we call a recession or a depression. And of course, there's another big problem with this that you all know, and that is that not only does the principal have to be paid back, but the interest has to be paid back as well, and the bank didn't create that when it created the principal. So the question then becomes, well, where does the borrower get the money to pay the interest? And from a microeconomic point of view, the answer is obvious. He goes out and takes a second job, or he sells something else to be able to pay off the debt that he has. He works within the system to pay it off. But the important question here is the macroeconomic question. Where does the economy get the money to pay the interest? And for this, there's only one answer to that question, and that is where all money comes from, and all money comes from loans. So you have to get a loan to pay off the interest from the previous loan. And that then becomes a cat chasing its tail, because the next loan then provides the interest that you needed on the previous loan, but doesn't provide the interest for its own loan, so you got to get another loan to pay the interest on that. So one loan demands the next loan, which demands the next loan, which demands the next loan, and the system has to grow. And as long as it's growing and lending is occurring, like we said, it looks like the system can function. But all of this time, money is essentially being drawn from the economy, from the economy off into the financial sector. Now, you may, and this produces this rising debt, and you've all seen data like this. This happens to be data from 17 countries over a long period of time. You see private debt going up, bank lending going up, interrupted by the things in the early 20th century, World War I, the Depression, and World War II, but the progression is still clear as the debt continues to rise with the system that we have. But you could argue, wait a minute, where do those interest payments go? Don't they get folded back into the economy too? And the answer is well, yes, somewhat. Some of that money that goes into the financial sector does get folded into the economy. But the people who are getting this money in the financial sector aren't the people who have to spend 80 to 90% of their income on absolute basic necessities. They've already got those covered. So essentially what that means is they have this money to put elsewhere, and they will invest it. And they will invest it in wherever they can make a profit. And so this investment, for instance, occurs in the stock market. And so what you see is the stock market is rising to new heights, again, as this investment occurs. And that's a reflection of this money shifting from the economy into the financial sector. Okay? So the financial sector either fails to grow or shrinks as this money is sucked out from the economy as a whole, where the 99% of us live, into where the financial sector lives. Okay? So, as money shifts into the financial sector, the real economy suffers from austerity, and we see that all around us. So, as a matter of fact, you can do a simple calculation, and in order to keep a constant money supply in the economy, the total money supply has to rise exponentially as it gets filtered off into the financial sector. And the steepness of the exponential rise is simply a function of interest rates. I won't show you this calculation, but I labored through it once to convince myself that this is true. So money creation by banks is a process by which wealth is systematically transferred from the many, the borrowers, to the few, the lenders, with every dollar that's produced and every dollar we spend. It's a systematic transfer of wealth from the many to the few, from the borrowers to the lenders. Okay, part 2. This part comes from conversations with a couple of bankers that I've had, and one of them has been particularly interesting. So I make this pitch to the bankers that he's creating money when he makes loans. And he says, no, I'm not. He says, we didn't create the money when we loaned it to a customer. We took it out of what we call cash. We took it out of an existing asset, just like anyone does when they loan money. And what you see in this two sets of bank statements is on the left we have the original condition. We have deposits and equity on the liabilities, and we have cash or the banker that I talked to likes to call it cash, but he realizes that doesn't mean it's coins and currency. It's just his category of liquid money. Okay, he calls cash. Okay, so the money is loaned out. That's the blue arrow going down. And the banker says, look, what we do on our balance sheet is we show a reduction in that cash or reserve. We've taken it out of that pool. And now we have that new loan up there, which does indeed keeps our total assets where it was. But you can see that we've taken it out of that pool, that cash or reserve pool. We haven't created new money. We've taken it out of a pre-existing pot of money. That's what he says. And I sit and scratch my head about that, and I say, well, but you know, your assets haven't decreased, and yet the customer has money which you provided to him. Doesn't that reflect the creation of new money? And he says, well, maybe so, but if you define money creation in that way, then any time money is loaned by anyone, money is created. Because if I loan $200 to my brother-in-law, yeah, he's got that cash, but I still have that loan, that expectation of a repayment. So my assets haven't dropped. Okay? So have I created money too when I made that loan to my brother-in-law? Okay. Well, that's an interesting question, and it raises the question then, and there's a whole another financial industry that makes loans that aren't banks, okay? And so the question is, then since we focus, and particularly the NEAT Act focuses on banks, then what's the difference between these kinds of lenders? What's the difference between banks and non-banks, okay, in terms of this whole business? And here's my tentative answer to the question. And I'm wading into an area that I have no expertise whatsoever, but I'm going to share with you these thoughts, and I'm sure you'll have lots of things to say about it, and I may learn a great deal from the conversation that follows. But I offer these thoughts. Lenders, in fact, face constraints to lending. Because as they lend, and this is any lender then, under their asset column, as their loans grow, their liquid assets decrease because they're loaning this money out of their liquid assets. Okay? So you can see as that occurs, maybe the loans are going to come bigger and bigger and bigger, and the cash is going to approach zero, and it looks like there ought to be a limit. Okay? Whoops, wrong button. Okay, so here, as cash now approaches zero, the lender faces a limit to what he can loan. But any lender can borrow more money to keep on lending. Okay? All you have to do is to borrow some more money. Now, you've got more liabilities because you borrowed the money, but you've got more assets, liquid assets, cash. You can continue lending. All right? So, lenders can continue to lend if they can borrow money profitably to make this possible. So for non-banks, really what limits their lending is these constraints of the market. Can I go out and borrow money that at a rate that will allow me to continue lending profitably? So somehow it's the market that limits that process. Now, for banks, it seems to me at least that the situation is, at least in principle, potentially different, in the fact that they can always resort to the lender of last resort, namely the central bank. And one of the functions of the Federal Reserve as a central bank is to maintain the health of the banking system. That's one of their things. You can read it if you go to their website. So they don't want to let banks crash. They want to let banks keep doing their thing. So when they're requested of loans, they are, my understanding is they're quite willing to provide these kind of loans. So a bank can borrow money and continue lending. So what happens to the bank balance statements at the commercial bank and at the central bank when the central bank now makes loans to the commercial banks? Well, what happens is that this blue section is the new money that's being created essentially by the central bank and providing it to the commercial bank as a loan to permit the commercial bank to continue making loans. Okay? So here is an example of the role that the central bank plays in creating new money, because the central bank didn't borrow it from anybody. The central bank simply created it. Okay? And in creating it, they just say, okay, we're going to create this money. It's more assets. Because we're going to lend it to this commercial bank, so we've got a liability now here because we, in principle, have to provide this money to the bank. All right, because we're loaning it to them. But all the commercial bank has to do is sort of increase this number in their assets column, and of course their liabilities column because they owe this money back to the central bank. And so they can continue to loan money out of this new cash. Okay, so there isn't any Brinks truck that carries the money from the central bank to the commercial banks. All that happens is you get an increase in these numbers that allow the commercial banks to keep on lending. Okay. Now this is a figure from that paper that has been referred to already. By McCleary from the Bank of England that occurred in the quarterly journal of the Bank of England. And it's a nice figure, and in a sense that it summarizes both of these ideas in this figure, because what you can see is on the far left, what you have is, this is a situation where there is a loan being made, so we have the buyer is seeking a loan from his bank, the buyer's bank, which is over there on the left. And then we're going to have a seller involved, and the seller's bank and the buyer's bank are initially represented there as sort of equal, and you can see they both have deposits, they both have reserves, which my banker would call cash, and in this case, what's listed separately is actual cash, currency. Okay. So what happens when the loan is made? And in the middle section of this is what you see is the buyer's bank, which is going to make the loan, increases its assets by making the loan, and it increases liabilities in the sense that it sets up an account for the buyer to use to buy whatever he's going to buy with this loan. Now the next step is the step that occurs when the buyer withdraws his money from the bank. Okay, so he really gets the loan, and what you can see is now that there's going to be as the sale is made and the check is taken from the buyer, transferred from the buyer to the seller, and the seller takes it to his bank. You can see there's a new deposit in the seller's bank that is just equal to the value of the new loan that was made. All right, and what and as I explained before, what happens then is the central bank will transfer the reserves. So you see that the reserves fall in the buyer's bank. And so that's my banker saying, I didn't create any new money. I took it out of that pool of reserves, okay? But what you can see if you look at the big picture, as a result of this, new money has formed, even though you can see why the banker says, I didn't create any new money. But what he did create new money that's not in his bank anymore, but it went to somebody else's bank, okay? So, and of course, this is happening from one bank to another, back and forth all the time. And so, in this way, the totals the money that is in existence continues to rise, because this new bank now can take and lend from these deposits, and when it makes a loan, it's going to send the money somewhere else and not going to decrease its total assets at all or liabilities in doing so. So you can see the system simply builds and the money does. But you can see why the banker is able to say, and I think these bankers I talk to, they're not bad guys, but they don't look at the big picture. They like to look at this very comfortable small picture and say, see, I don't create new money. I take it out of a pre-existing asset. So it's been an interesting conversation for me about this to deal with this. So anyway, what makes banks different from other lenders? There are two big things. One is that, of course, as depository institutions, they have this enormously big asset of all the deposits that are with them from our checking accounts. That's a big advantage, because that's virtually all the money in the system, okay, that they can use as the basis for making loans, okay? They can make loans against those deposits. And as banks, the other thing is banks, they can always go in bad times to the central bank when they get in trouble. And other lenders cannot do that. It's exactly what happened in 2008 when the banks got in trouble, that they went to the central bank, the Federal Reserve and the Bank of England, because this happened elsewhere as well. And there they can go to get loans at very low rates, okay, the lowest rates you can get anywhere, okay, big advantage for the banks. So my tentative conclusion here, good, I'm just about done, right. My tentative conclusion here is that when a bank provides loan money to a customer, that money does come out of a pre-existing source, namely the banker's cash reserves. However, whenever money is loaned by banks or non-banks in a sense, money is created. Now, what will the Need Act do then? Well, it certainly will prevent commercial banks from lending against deposits. That's Section 1, that's Title I, Section 102 is very specific in the Need Act to say banks cannot loan against deposits, okay? The other thing the Need Act does, it'll produce money creation by the banks, and that's absolutely vital for all the reasons that Nick talked about in terms of what money can do to solve issues of fairness, of social justice, of survival of the system in terms of infrastructure and all the rest. The Need Act will still permit lending. It does not prohibit private lending, okay? It can permit lending against equity or against other borrowed funds. So it will not prevent credit extension. In a sense, it will not prevent all debt money creation. But through indirect means, namely through the provision of money from the government end of things, it will have an enormous impact on decreasing the amount of lending that will have to occur. So, and it will free the economy from its dependence on debt money for growth. It will make a just society and a stable and sustainable economy possible. Doesn't guarantee it, but it makes it possible. And it provides at least the hope of achieving environmental sustainability. So I'd just like to thank Steve Zarlenga for introducing me to this whole thing through his book, the opportunity to speak here, and thanks to Jamie for his role in organizing this, and thanks to all of you who have played a role in my education over the last few years of attending this conference.